I am Titty Hunter, and I can also make Silver Asian AI Guy videos. Buckle up because silver is going to the moon. In 1964, the federal minimum wage in the United States was $1.25 an hour. And back then, you could literally be paid in 5 silver quarters, real silver, 90% pure. Each one contained about 0.808 troy ounces of silver. So those 5 coins together equaled 0.904 ounces. Fast forward to today. If silver is $80 an ounce, those same 5 quarters, that same 1 hour, minimum wage paycheck would melt down to about $72.34 just in silver value. And here's where the story really opens up. If you worked full-time in 1964 at minimum wage, you earned about $2,600 a year. Today, someone earning a high U.S. minimum wage is around $15 an hour, makes roughly $31,200 a year working full-time. But if we price that same 1964 wage in silver using today's silver price, that 1 hour paycheck becomes $72.34 an hour, and a full-time year at that rate works out to about $50,000 a year. Same job, same time, same human effort. The only thing that changed was the money. In 1964, a minimum wage worker could often rent an apartment, support a small family, save, and in many parts of the country, eventually buy a modest home on one income. Today, minimum wage barely covers rent, if that. Silver didn't suddenly become magical. It simply held its value. The dollar didn't. And when you see that a 1 hour minimum wage paycheck from 1964, paid in silver, equals the yearly income of a modern professional job today, you start to realize people weren't promised less. The currency delivers less, and once you see it, you can't unsee it. Let me tell you a secret about money, one almost nobody ever tells you. Inflation is not an accident, and it doesn't hurt everyone equally. There's a name for this. It's called the Cantillon Effect, and once you see it, you can't unsee it. Here's how it works. When new money is created, whether through stimulus, bailouts, QE, or financial engineering, it doesn't rain down evenly across society. No, it enters through the top of the system first. Banks, hedge funds, corporations, asset owners, they touch the new money immediately. And what do they do with it? They buy real assets, stocks, real estate, land, commodities, all at yesterday's prices, before inflation fully shows up. Meanwhile, the working class, they don't get this new money until much later. They get it after prices have already risen, after housing has jumped, after groceries cost more, after rents inflate, after assets have already been bid up. So what does that mean? It means those closest to the money printer get richer, and those furthest away get poorer. Not because they worked harder, not because they took more risk, but simply because they touched the money first. Think about that. A banker gets access to a near zero interest loan. He buys an apartment building. By the time that money filters down into wages, the working class family is paying higher rent to live in the building he already bought. The rich buy assets at yesterday's prices. The poor pay tomorrow's prices with yesterday's wages. That right there is the Cantillion Effect. Inflation isn't just a number on a government report. It's a stealth tax, a hidden wealth transfer. From savers to debtors, from wage earners to asset owners, from the many to the few. And the brutal truth? Most people don't even realize it's happening. They just feel like they're running faster every year, only to fall further behind. Meanwhile, the people closest to the money printer smile because they know when money is created, wealth isn't added. It's redistributed. And if you're not first in line, you're the one being diluted. That is the real game. And that is the Cantillion Effect. What you're looking at right now is something I call the Precious Metals Peak Indicator Scorecard. This isn't a price target. It's not a hype graphic. It's not meant to predict tomorrow's move. This is a framework, something I built to help answer one question that every investor eventually asks. How close are we to the top? Because when you're in a secular bull market, like I believe gold and silver are in, right? Now, the hardest thing to do is not buy. It's to hold on when the price starts moving violently. And lately, we've seen wild swings. Gold moving hundreds of dollars. Silver ripping, pulling back, ripping again. So if you're staring at your screen thinking, holy crap, are we getting close to the peak? This scorecard helps ground you. Let's start with gold. If you take the 1980 blow-off top in gold and simply adjust it for the increase in the money supply, you get a range somewhere around $7,670 to $11,050 per ounce. Now look at the current level on the chart. We're roughly around $4,300 right now. So if all this scorecard did was answer one question, are we near the top? The answer, at least historically speaking, is not even close. Stay long. That doesn't mean the price goes straight up. That doesn't mean no corrections. That doesn't mean no pain. It just means we're probably still in the middle innings, not the 9th inning. Now silver. This one blows people's minds. If you adjust silver's 1980 peak for today's money supply, you get $429 to $647 an ounce. Right now, silver is around $71 an ounce. So again, purely from a macro adjusted lens, the scorecard says, stay long. This isn't what a final peak normally looks like. And remember, the 90-80 peak happened in a world with less leverage, fewer financial products, slower information, less monetary expansion. Today, we're swimming in liquidity compared to back then. So the ceiling may actually be higher than this historical normalization suggests. Next, the gold to silver ratio. In 1980, at the top, the ratio compressed to around 15 to 1 dollars to 16 to 1. Right now, we're still much higher than that. And historically, when the precious metals mania phase kicks in, silver outruns gold. That's when the ratio collapses. So again, the scorecard says, we're not there yet. Stay long. And finally, the Dow to gold ratio. In 1980, this fell toward 1 to 1, meaning the Dow Jones Index, roughly the price of an ounce of gold. That was full-blown panic out of paper assets and full-blown rush into hard assets. Right now, we're nowhere near that. So one more time, this doesn't look like the top. Now here's the important part. This is not about calling dates or exact prices. This is about orientation, about staying rational when the chart looks insane, about not letting emotion kick you out of a winning secular trend too early. Here's the key mindset shift. 80% of gains in a secular bull market happen in the final 20% of the time. And we may only now be entering that phase, which means volatility will rise, swings will get bigger, news will get louder, your emotions will get tested. And that's exactly when frameworks like this matter the most. Now, before someone freezes the screen and says, but silver is X dollars today, let me be clear. These numbers are fluid, extremely fluid. We've been swinging violently intraday, up, down, sideways. So what you're seeing on this scorecard right now is a snapshot in time. By the time you're watching this video, the price could be higher or lower, or it could have whipped both directions in the same hour. So don't obsess over the exact digits. Focus on the macro position. We are far closer to the beginning of the final run than anywhere near the end. And honestly, we don't even have the momentum crowd yet. Wall Street Bets isn't talking silver. The average investor thinks gold is boring. Most people still believe AI stocks are the only game in town. That's not what mania looks like. Mania is Uber drivers talking metals, CNBC anchors breathless, everyone chasing miners. By the dip becoming religion, we're not there. Not even close. Your job is simple. Stay informed. Stay level-headed. Don't get shaken out by volatility. And, very important, have an exit strategy ready for when the mania phase finally shows up. Because when this thing does go vertical, it won't feel calm. It won't feel logical. It will feel euphoric. And euphoria is dangerous. So that's the precious metals peak indicator scorecard. Not a prediction. Not hype. Just a macro dashboard to remind us. We may still be early in the endgame. Volatility does not equal danger. Volatility is what the final act of a bull market looks like. And we're just getting started. This is Titty Hunter, signing off for 2025. Incredible year. And if history rhymes, 2026 may get even more interesting as silver pushes closer to its secular bull market peak. See you there? Quick disclaimer. This is not financial advice. Do your own research. Make decisions that fit your risk tolerance.